back to the loan level for a second. I'll walk through a hypothetical about what happens on a lender's balance sheet when a loan goes delinquent. And I'll use a $200,000 loan, goes delinquent. It goes 45 days delinquent, and the FDIC comes up, let's say it's Bank of America, knocks on their door, says, hey, Bank of America, I see you have this loan that's 45 days delinquent. I need you to set aside some of your equity capital in case you suffer a loss on this loan. So the FDIC might tell them, set aside $2,000 of your equity capital. So that equity capital that the bank uses to make loans is all of a sudden tied up in the lost reserve account. They make them put it in a lost reserve account, they set it aside, bank, you can't touch it. Well, that $2,000 in equity capital represents maybe $30,000 in the bank's lending power, because for each dollar that the bank loans out, it only puts in about 2.5, 3 cents of its equity capital. The rest of the money is borrowed from your checking, your savings, selling CDs, borrowed from the Fed. So that's painful for the bank because they're losing the opportunity to make a $30,000 loan to someone and collect that interest. So that's the first step, that 45-day delinquency. So let's say this same loan goes 90 days delinquent. In this market, the lenders aren't even putting people in foreclosure, often 6 months or a year. But let's say 90 days delinquent, under historical standards, the lender would file a foreclosure suit. They file that foreclosure suit, and all of a sudden it shows up on a different list to the FDIC. The FDIC comes knocking, and this is just to give you the structure of how it works. It's not actually how it works. The FDIC can't look on a loan by loan, but the loans will show up in theory on a list. So the FDIC says, gee, lender, do you have an appraisal or a BPO more recent than a year on this loan? So they go out and get one. And if they're lucky, it comes back at $150,000. So all of a sudden, the lender's owed $200,000, the property is only worth $150,000. The FDIC tells the lender, gee, you have to take $25,000 of your equity capital, half of that amount that you're upside down, take it off your balance sheet, put it in the lost reserve account in case you suffer a loss. That $25,000 of lender equity capital takes away their ability to make an $800,000 loan or $1 million loan. So that is painful. And that is basically the whole main driver, or one of the main drivers behind the $800 billion bailout, is simply because all of the banks, or a large portion of the bank's equity capital, was pushed into these lost reserve accounts. And so the banks really didn't have the equity capital to continue to make loans. So with the bailout money, it put money back on the bank's balance sheet so they could continue to function. Also, in addition to the lenders relaxing the standards as far as mark-to-market, the lenders also tweaked how much money, the government tweaked how much money the lenders had to set aside in these lost reserve accounts. So they took a number of actions to help prop up banks in general. But once, and just back to my hypothetical, so once that situation exists, all of this money, let's say $25,000 of the bank's money is sitting in this lost reserve account. The bank's main goal is, well, gee, I have a $200,000 loan that's preventing me from making a $1 million loan. How do I get that $25,000 and put it back on my balance sheet? In theory, the way they do it is they resolve the loan in some form or fashion. One way that the lenders probably aren't too happy with, and I'll show you specifically later, is through a loan modification. If the lender modifies an upside-down loan, they may be able to recover $15,000, maybe $20,000 of that lost reserve, because then they can put a performing loan back on their books. But still, they're sitting with $5,000 or $10,000 that's often in lost reserve account that they can't use. Over time, that is a huge waste of the lender's money. That's one of the main reasons why the lenders are somewhat unhappy or displeased to modify loans. The government says, well, we bailed you out, here's your $800 billion, so you guys quid pro quo, modify some of these loans, and it's just an act to, try to please the people instead of really good for the bank in the short term.